Hey guys, today's episode is with Greg Castle of Anorakvc. Greg talks about how he became a VC. He also talks about what he's investing in, which is a lot of deep tech and robotics, applied robotics startup. What he's looking for is pretty interesting. If you like this kind of content, hit that subscribe button, leave us a nice comment, and then email us at info@foundersuite.com, and I will send you a list of 1,100 deep tech investors. So if you're in technology, robotics, advanced AI, that kind of space, this list will be super valuable for you. So hit that subscribe button, leave us a nice comment, email us at info@foundersuite.com, and I will send you that list of 1,100 deep tech investors. Until then, enjoy the chat with Greg.
Welcome to How I Raised It, the podcast that goes behind the scenes with entrepreneurs who've raised capital. We uncover the tips, tricks, and techniques they use to get investors to write a check. Strap in and turn it up.
Hi, welcome to another episode of How I Raised It, produced by Foundersuite.com. Today I have Greg Castle of Anorakvc coming to us from Los Angeles. How's it going?
Good, thanks. How are you?
Very good. As we're recording this, Greg's just about to become a new father, which is exciting. A little golf clap around that. So Greg's a VC, probably you don't want to be pitching him, or I don't know, maybe there's an opportunity in your sleep-deprived delirium that you're about to be in. Maybe there's a great window of, time to pitch you, and you'll just be like, yeah, sure, whatever.
I'll take it. Just send me the wire details.
Yeah. Interesting. Well, give the little overview about Anorakvc.
Sure. So we are a pre-seed and seed stage firm that is focused on investing in companies that are being built around differentiated technology. And so we tend to invest in technical founders, although not exclusively. And really just looking for good, passionate founders who have a vision for something big. Yeah, really like to get in at the earliest stages, roll up our sleeves, just being helpful along the way.
Being helpful. I'm seeing, like the website, your interests are things like robotics, VR, computer vision, and you're doing the really early stages. Some of these things like robotics are, capital intensive. So I guess how do you sort of triangulate a good robotics startup at the pre-seed stage, right? Or that seems like that'd be a challenge.
Yeah, it is. Especially for smaller funds like myself, when you're dealing with capital intensive projects, it can be a challenge. But the robotics knowledge and the application of robotics is something that's deeply interesting to me, because there's a lot of things that we're doing out there, repetitive, mundane, dangerous tasks that are still being conducted by humans, whether or not you're talking about, cleaning the fins on a for a wind farm on turbines, or you're talking about checking the shelves in a supermarket. There are things that are pretty either dangerous or repetitive, that where there are applications that where robots can help and can replace labor and enable people to be focused on more important, creative, fulfilling tasks. What I'm looking for more in the early stages is it's the application, not necessarily the unique technology. Because I think, one of the things that's exciting to me is how commoditized the technology as a whole is getting. There still is a whole bunch of, there still is not knowledge, and it's not an easy thing to do. It's still very technical. There's no question about that. But it's becoming more and more accessible. It's becoming cheaper. It's becoming easier to use. And so really what I'm looking for in the earliest stages are, what are those interesting use cases that have the potential to be automated, using whether or not it's using robotics or using computer vision. So that's what I'm looking for in the earliest stages. And also for sure, as you just said, these are expensive. These are expensive businesses sometimes to build. And so, making sure that there's a plan in place for how you're going to be able to get there without, raising a, $25 million Series A. Not that there's anything wrong with that, but I just don't want that to be the main plan. Kind of capital efficiency is an important thing that I look at the earliest stages.
How do you become a VC?
I think VCs have lots of different paths as to how they have gotten there. There are people who take more traditional paths of studying finance, going into investment banking, and going kind of more the traditional finance route. There are people who were founders themselves and wanted to be on the other side of the table and work and share their knowledge with a lot of other founders and become investors. And then there are all kinds of stories in between and loads of, my story happened to be one where I started investing and I had some luck with my own capital and discovered a passion for working with early stage companies and investing capital and investing my time and advice and that kind of, it was kind of an organic evolution of me starting to invest my own capital over a span of about 2.5 years, to me, to there being a bunch of people who are coming up to me and being like, hey, I like what you're doing and I'd like to get involved with some of the deals. And so that kind of organically became me creating SPVs, special purpose vehicles, to make other investments with other people. And then that led to me creating a structured fund in 2017. So that was Anorak Fund 1.
So let's go through that journey, because really this show is about raising capital, and I want to kind of delve into that, raising that first fund. So maybe just go into more detail on that whole journey of kind of doing some angel deals to SPVs. Maybe talk about that as a stepping stone towards becoming a VC.
My advice generally is you just got to get going. You've got to start deploying capital. You've got to start understanding the business. You've got to start growing your network. And even if those checks are really small checks, $5,000, $10,000, you just have to get out there and start doing it.
Okay.
And so, for me, because I was in the fortuitous place of, having Oculus go from founding to exit in 18 months.
Yeah.
When Oculus exited, I suddenly came into a bunch of money that enabled me to start investing my own capital.
Was that your first deal?
Essentially, yes, it was.
That's crazy.
Yeah. And I did it and I said, oh, this is easy.
This is easy. 18 months.
Full time. Yeah, exactly. So, after that happened, and even before, to be honest with you, I started making some other investments in other companies. But once the money hit the bank from the Oculus deal is when I really started to accelerate, because I could. And so it just came to me, starting to get involved in some good deals with some good founders and, being referred other deals and, going to YC Demo Day and starting to, get involved in the whole scene. And it was just, look, I worked my network and I worked hard to be able to get into the deal flow, to be able to go out and meet people and have coffees and understand, how this whole weird world of early stage investing works. But it all starts with you just, you can't, I think too many people, whether or not it's in business or it's in venture, are sitting there thinking and pontificating and, it comes down to execution, right? And you're going to make mistakes, and that's just part of the game. And so, I was in a good position that I made a whole bunch of mistakes on my own dime, right? And so I made, the second investment I made after Oculus turned out to be a complete bust. The founder was a fraud. The third one, pretty much the same. The fourth one was another good deal. And then the fifth one was a good deal. And then I started to figure out how this whole thing works. But you just got to get out there and you just got to start doing it. And I think AngelList has done a great job of kind of breaking down those walls and making it much easier for people to start leveraging their network and getting exposure to how venture works.
Did you do some SPVs on AngelList?
I didn't. I've never used AngelList for an SPV.
So go into that a little detail then, even for people who aren't familiar, what does it mean to create an SPV? Why do you do it? How does it work? Just give a little 101, SPV 101.
Sure. So all an SPV stands for special purpose vehicle. And all it is you create a legal entity generally in the form of like a Delaware partnership. And you have a bunch of people put money into that company, and then you use that company as an investment vehicle to make other investments. And so rather than if you write a check into a company, rather than if you want to invest with 8 or 10 other of your friends and everybody wants to throw in, let's say 25K or 50K, rather than doing it from 8 or 10 different people, you just have everybody, pool their money together, and it comes out of one vehicle, one dedicated vehicle to making investments. Mm-hmm. And so that's essentially what an SPV is. It's nice because, a founder then it's, as anybody who has raised money beforehand knows, like dealing with investors is like herding cats. Mm-hmm. It's a pain in the butt to deal with all of these different people, get all of the paperwork signed, get all the wires done, all of these different things. And so if you make it easy for a founder to accept your money by pooling a whole bunch of other people and just creating one single entity, then that's a plus. That's going to make it easier for you to deploy that capital. So that's what an SPV is.
Got it. It makes sense. And so are you doing these SPVs, one, to make it easier for the founders that you're investing in, and two, to kind of start establishing this track record to be able to go raise, a venture fund? Is that also part of it?
Yeah, I think it was both of those. And I think, so I hadn't made up my mind when I started doing the SPVs that this is what I wanted to do yet. I still didn't know whether or not I was any good or if this was just a fluke, investment that I made. But I would say yes to both of the things that you suggested, but also, it's not like I made billions on the Oculus deal. I was a small investor in the friends and family round. The multiple was incredible, but it wasn't enough for me to retire on for life. And so the way that I saw it was, if people believed in me and people wanted to invest with me, then rather than taking, I don't know, call it $100,000 and making, 4 investments or 6 investments with that $100,000, I could take that $100,000, team up with, 8 or 10 of my friends, make that $100,000 $1 million. And then instead of investing in 6 companies, I could invest in 15 companies. And each company that you invest in is experience under your belt. It's another company that goes into your portfolio. And so it was more of like a peanut butter, methodology of like, rather than just making my 100K work for me, I could make $1 million work for me and have a lot more, just gain a lot more experience off of that same amount of money and a lot more exposure to deals and learn a lot more.
Mm-hmm. Yeah. And so let's keep going on the chronology a little bit. When did you decide, hey, I'm ready to go raise a proper venture fund and I think I'm qualified or eligible, or, I think I can do it now, right?
Yeah.
How do you sort of have that aha moment?
So I would say 2 things. One, just to finish off on what I was saying beforehand, I didn't take any economics when I created these SPVs initially. I felt as though people were taking as much of a chance on me as I was on, as was worth my time to put in the work, that an unproven person was going to be deploying that capital. And so I just said, look, if you want to invest in me, if you want to invest with me, I'm not going to take any economics. So I'm not going to take a carried interest. I'm not going to take management fee, anything like that. So that's the way I started doing it. And I've told other people
the deal together and taking your pro rata portion of the money you're putting in. You're
correct.
Additional fees or management fees on top of it.
Correct. Exactly. So for those who don't know, essentially the way that the economics for venture capitalists like myself work is it's generally on a 2 and 20 structure. So 2% management fee on everything that is on assets under management, essentially for that fund. And 20% carry. So that means once all of my investors make their money back and are even, 20 cents on the dollar of every additional dollar that comes in above their initial investment goes to the partnership. So that's the way it generally works. And that's how VCs make money. So I didn't do any of that initially because I felt like, I just didn't feel like I deserved it, frankly. And so I did that for a little while, and I probably put together, 3 or 4 different SPVs for different for different kind of, I did one specifically with a friend for a YC cohort where we just like liked a bunch of companies in this particular YC class and basically spent like 2 months deploying, 2 or 3 months deploying this capital almost entirely in YC classes. I did another one for, and then I did 2 more essentially. But after a while, we had a more, there were more kind of, there were more signals that I knew what I was doing, just in the sense that we got into a bunch of really good deals. And so there was more and more interest to keep on doing this. And SPVs can get unruly and they're a pain in the butt because you have all these different legal entities that you need to service every year. You need to do filings for every year. It's just a pain in the butt. And so, after enough time, basically, I gained the confidence that I felt like I knew what I was doing as a VC, that I felt like I could pick good companies. And I gained enough confidence that I could be a responsible steward of capital. And I knew what it took to be a VC, that I said, and lastly, I would say it just became too cumbersome of people saying, hey, I want to invest with you, that I just said, okay, I'm going to create a proper fund. I'm going to, do this full time. And so I did it. And, I was shooting to raise 12 million. I ended up raising 13 and a half. It was basically an extension of my angel activities. I wasn't leading rounds. I was getting involved with lots of different companies and, investing alongside, big funds, founders that I liked, and really leveraging my network.
You raised this fund. I want to talk about how you did that. Was this all just from friends and high net worth folks on that first $13 million fund, or did you go after any LPs, like kind of traditional LPs?
Yeah, there were people outside of my network who got involved. I would say it was probably, I don't know, half my network, maybe like half my network and friends and family, and half outside people who, are more traditional LPs.
Let's go into that a little bit. How did you identify those folks? You've got this track record, you've got the previous angel deals, the SPVs. How do you, and I'm sure it's fairly straightforward to circulate what you're doing now to your friends and family, but how do you sort of identify and reach out to these strangers, so to speak?
Yeah, it's mining your network. It's getting out there. It's doing podcasts like this. It's, having people hear about you, identify with, your view on, where the future is going. It is certainly mining your network and people who you've known from previous lives or other personal connections that you have. And it's, it's just like any other networking / biz dev activity. It's like, a lot of VCs, especially first time VCs, they use a CRM, like the same type of CRM that a B2B, SaaS company would use, where you're going out, you're looking for leads, you're, taking, you're treating them like they could be customers. I didn't do that,
by the way. So here's my product plug right in the middle. Foundersuite is a great investor CRM for managing your investor pipeline. Okay, cool. Carry on. Insert a little commercial. Sponsored by. Carry on.
So I never used the CRM actually. It probably would have been easier if I did, but I just was organically both getting reached out to and reaching out to people to get them excited about, the types of companies that we get involved with.
What materials did you have? A pitch deck, a prospectus, some other sort of just a pitch deck that you were kind of circulating? And
yeah, so I had, for Fund 1, I had a pitch deck. For Fund 2, I have a pitch deck and a data room. And the data room, has more detailed information on the companies in Fund 1, on, historical financial reports from Fund 1, historical investor reports, all of that stuff. So it goes into a little bit more detail.
Cool. So $13 million Fund 1. And how long did it take to raise?
So 13 and a half, that half is very important. And that took me about maybe 8 months to raise.
Yeah. Any just other anecdotes or tips for, because I think this is what a lot of people who are considering becoming a VC, maybe they've been doing angel investors, they're just trying to understand, like, how long does it take? How hard is it to raise that fund? Any other tips or advice for people to raise that first fund? What was it that made it work for you? Key to the castle, Greg Castle. Or,
So I think really, I think momentum is important when raising a fund or when raising for a company. Like, I always, as I mentioned beforehand, like, I never stopped deploying capital, whether or not it was my own capital or or whatever it was. Like, initially it was my own capital, then it was out of SPVs. I was always out there and getting involved, and getting involved in good deals. And that kind of notion of you're not waiting on anybody, like the train is leaving the station and either people want to get on or they don't, I think is really important. I think that that's important for founders as well. I tell that to my founders all the time. Like, don't reach out to a potential investor or potential customer with just asking for an update on their decision process. Like, every time you reach out to them, there should be some more news that gets them excited about what you're doing.
Yep.
So that should be some form of forward motion.
Yeah. I like that. Yep. That's good. Cool. Congrats on that. And then you deployed that. And then when did you decide to raise fund 2, this most recent fund? And, I guess how much of that fund 2 is dependent on unrealized returns in fund 1? You know what I'm asking?
Yeah. They often say that, like, fund 2 is the hardest, fund 2 is the easiest, fund 3 is when the rubber hits the road. Because for fund 2, oftentimes the jury's still out as to whether or not you know what you're doing, because it's still so early in the fund life cycle. So, in terms of when I knew that I wanted to raise fund 2, was when the capital in fund 1 was deployed.
Yeah.
So I had a certain amount reserved for first checks. And once that started to come to a conclusion, then I started having conversations with my existing LPs, and, almost all of them ended up reinvesting, and most ended up actually investing a little bit more. And then, I'm off to the races with fund 2.
And did you expand that pool of capital to any other investor types or LP types?
Yeah, fund 1 was mostly just internal folks, but the first close was mostly just internal folks. But the second close, which I'll be doing at the end of this quarter, will include a bunch of new people.
With fund 2, do you get into, pension plans and things like that yet? Or are you still more going toward?
It's a bit of a small number for most pension plans. Pension plans, if they're going to put in the time to do due diligence, they want to be writing, $50 million checks, $25, $50 million checks. My fund will likely only be $25 million. So, I only really have room for, 1 or 2 checks that are above $5 million. So it's a bit small for the larger institutions. Having said that, there are larger institutions that are starting to change their tune about how they're deploying capital and how they're using funds. And I think one thing that Anorak provides is that we really aim to over communicate, in the sense that we write monthly updates to all of our investors that say, these are the companies that we're excited about, and these are the new investments that we've made. And so there's a bunch of larger companies, there's hedge funds, there's a bunch of larger endowments that are interested in getting involved for what is relatively a small check, whether or not it's $5 or $10 million for them, but they want to do it because they want the access and they want the exposure to what's going on at the very earliest stages. Later stages have become so competitive that I'm seeing more and more that larger funds, whether or not it's fund of funds or endowments or hedge funds, they want, they want that relationship early on, so that they set themselves up when the company gets successful to be able to write that much larger check.
Sure. Yeah.
Things are changing on that front a bit.
Yeah, that's good. Cool. Great. Any other notable advice or just anecdotes from fund 2? It's yeah.
I'm just really excited, and I really, consider myself blessed to be able to do what I do, and be able to work with amazing, passionate founders who are working to change the world. And it's really a dream job. It's not easy, and it's oftentimes I find myself being kind of part part investor, part psychiatrist, because
Sure.
building a business is tough. It's all consuming, right? And so just being there for the founders and helping them, as I mentioned beforehand, there's so much opacity, helping them understand what's normal, and how other founders are dealing with employee issues, personal issues, all kinds of things like that, is something that I think a lot of founders find really helpful, and I'm lucky to be able to do it. So I love it. And I guess the other thing that I would say is for founders who are building companies, I think it's really important in any job where you're selling something.
Yep.
And founders are selling their startups, and I'm selling my fund, everybody's selling something. It's great to really understand all sides of how it works, right? And so understanding the perspective of VCs, reading a book like Venture Deals is like a really famous book that Brad Feld wrote about how kind of the business of venture capital works. Understanding how we get our money and how we make decisions, I think really can help founders in their journey of fundraising and engaging with VCs. And so, I hope that some of what I've said today has provided insight to some founders who are out there listening and raising funds themselves.
Yeah, good. All right, we'll let you go in just a moment here, but just a couple quick queries here, kind of more about like your current investing style. Are you doing a lot of Zoom? Are you doing any deals completely virtually these days over Zoom?
Yeah.
Yeah.
100%. I mean, you have to. I actually saw my first company, because it was a hardware product. I saw my first company in person last weekend, and it was strange, to go back after a year.
To go back to pitch. One of the things I'm getting asked a lot, are you looking, has the fact that things are virtual now increased your aptitude to take a look at companies based internationally or all over the place? Are you looking at deals from all over the place nowadays?
Yeah, 100%. It's funny, I used to have my geographic concentration is something that LPs used to ask about a fair amount, and still do for that matter, like where your company's based. And I was updating my graph the other day and for my pitch deck, and halfway through I was like, this is so irrelevant now. Like, companies are being built online. That's just the reality. And I don't know whether or not in 5 years, like, people are going to this used to be a big thing. Like, we only invest in the US, we only invest here, we only invest there. It's like, that's just not the new world. So I was slowly kind of diversifying outside of the Bay Area beforehand, but it has certainly accelerated that.
That's interesting. And then I guess the other question people always ask me is, you're doing pre-seed and seed, pretty early stuff. Like, are you expecting revenue? Are you expecting traction? Or are you looking at vision and product at those early stages? What are you kind of,
I mean, it all depends on the deal, but I generally describe it as like, if you go through the stages, there's probably some cool infographic out there, but like, as you go through the stages of a company and you go from like pre-seed, seed, A, B, C, D, public, like, if this is the amount of information that you have to work with on the actual company, and this is the importance of the team and their vision, like, pre-seed, it's like this, right? There's so little information, there's so little track record, and then you get to the seed and it's like, you want there to be some data for you to make your decision off of. And then A, it's like, have you hit your metrics? And then B, it's like, it becomes a lot more about the metrics. The team, is super important, but if you're hitting your metrics, like, the team can be perhaps adjusted as the board fills out. And then like D, E, kind of, I mean, team is always important, don't get me wrong, but you're really looking closely at the team and really trying to, get in their brain of like what drives them and what makes them tick and what their vision is and how they deal with adversity and things like that. Because you have so little data to base your decision on, like so little hard data, I should say.
Totally. All right. Last question. Again, one that's always asked, do you require the warm intro? Do you prefer the warm intro? Do you not give a damn about how people reach you?
No, the warm intro always helps for sure. Who the introduction source comes from is something that I weigh quite heavily. I mean, if it's somebody who, it's just the nature of the beast that when people know that you write checks for a living, like, my inbox is filled up every day with cold emails, with, outreach on LinkedIn, outreach on Twitter, like all these different things. And so it's difficult to sort through all of that noise.
Yep.
But if somebody contacts me who I know and who I trust and says, look, I grew up with this guy, I think he's really smart, I've seen what he can do beforehand, he's interested in speaking to you, then like that's going to help for sure. I'm going to want to get on the phone versus, one of the, 3 dozen emails I get every day from a cold outreach.
Only 3 dozen. I thought it'd be 300.
I was probably about 3 dozen a day, I would say, or 2 dozen a day. But I would say short of that, like, look, there's some people who are just not going to be able to get to me. Maybe they grew up on the other side of the world and we have no common connections, and that's cool. But I don't want to miss out on that opportunity. And so, if there is, a meaningful way that they can reach out to me, whether or not it's something that they create to show me or a thoughtful email that they send me, like that is, I'm going to react to that more than I'm going to react to, a constant contact email that a founder blasted out to a list of investors that they got off the internet.
Totally. Yeah. Have you done any deals that came in cold, even a thoughtful cold,
Yes, I have. I definitely have. I've done more than one, to be honest with you.
Not to encourage people to do the cold, but yeah, just it's always kind of interesting. All right, awesome. I will let you. It's Friday afternoon. I'll let you get off duty here. People want to learn more. Anorak.vc.
Correct.
Yep.
Anorak.vc, or you can follow me on Twitter. GP Castle 12. I'm pretty active. I'm on there pretty often.
Okay.
Twitter.
Do you get pitched on Twitter very much? I'm always curious. Like, there's so many VCs on Twitter now. Like, does that ever lead to a deal? I guess maybe.
It definitely leads to meetings. I can't think off the top of my head if I've ever done a deal from a cold outreach off Twitter, but I likely have. I mean, I get people who are who send me direct messages pretty often on Twitter.
Yeah. Interesting. Cool. Excellent. Well, thank you very much. Have a good weekend. Congrats on the newborn coming soon, and we'll catch you later.
Thank you so much.
Thanks, sir. Bye.